Welcome to the March edition of the Balanced Perspective with me, Mansoor Naka of Nedgroup Investments, and giving us insights into today's topic, we have on the line Iain Power of Truffle Asset Management. Welcome, Iain.
Hi, Mansoor, and welcome to everyone joining us on the call today.
That topic being Japan, or the opportunity for investors in Japan specifically. Japanese equities has recently picked up renewed interest from investors for a number of reasons. In fact, looking at the Nikkei as we speak, it is reaching record levels, with that index, of course, being driven by exporters and the technology names in that index. But I think one of the structural changes we are seeing are the reforms introduced by the Tokyo Stock Exchange. Iain, can you tell us specifically what this means for Japanese equities?
Yeah, thanks, Mansoor. I think Japan, an interesting destination. I mean, certainly out of the developed markets around the world, it's been a relatively cheap market from a multiple or valuation perspective. And I think, the other factor is you've actually got lots of high quality companies which own great technologies. They've got a lot of IP, and certainly the price of those assets has been fairly cheap for a long period of time. And I think for a period of time, the cheapness was probably right because there wasn't a big focus on shareholder return. In other words, for many, many years after the bubble that one saw in Japanese assets, lots of these businesses had lazy balance sheets, built up lots of cash, really didn't focus on shareholder return. Raising prices was something of an evil. If you're a Japanese company, it was something that you should be ashamed of. And I think the whole focus and I suppose mindset around company management has started to change over the last decade, slowly but gathering more momentum, in that what one is seeing is a lot more shareholder activism, a lot more willingness from Japanese companies to focus on unlocking shareholder value. And that has now been really enforced by the Tokyo Stock Exchange, which has put in place a structure which is effectively going to name and shame companies that share prices trade at valuations below their book value. So what does that mean? It means that if your share price is trading below the value of your shareholders' funds or the NAV of your business, you will effectively be named and shamed by the stock exchange. And what they want companies to do is to put a plan together for all those businesses that do trade at those cheap multiples on how they are going to unlock that shareholder value, whether it is distributing more of their cash on the balance sheet, getting rid of lazy assets, share buybacks, etc., etc. What are the plans that they're going to put in place to then drive increased shareholder value? Now, as you would know, Mansoor, is when you start pushing up returns or returns on invested capital or returns on equity, you tend to get a better rating in terms of those assets. And that's in fact exactly what we're seeing. So you're seeing a re-rating, a structural re-rating starting to take place. And I think it's primarily been led by the big exporters, which you mentioned, which have been driving returns, particularly if one looks at like the Nikkei 225, where they're overrepresented. But I think even aside from that, if you just look at the broader topics market, you're starting to see now decent re-rating and decent returns to shareholders coming from these initiatives. And what's nice to see as a shareholder is the incremental share buybacks, excess dividends, where many of companies which had between 40, 50, 60% of their market caps in cash on the balance sheet are now starting to distribute that back to shareholders. And I think that that's a positive and will continue to drive what we think is decent returns out of that developed market cohort, where we think Japan still looks pretty underpriced. And I thought what I would do for just many of the clients is just give them a quick snapshot of some of the companies or the quantum of companies in Japan that trade at a discount to NAV. So on the topics today, which is the biggest index, has the most companies, 47% of that index trade below NAV. So, if I said to you, what percentage of the S&P do you think trades below NAV of those companies in the S&P 500? What do you think that number is? I'm putting you on the spot, Mansoor. What do you think the number is?
If I look at the
Okay,
S&P,
I'll tell you.
I would say zero
Yeah.
actually.
So 4%. So exactly, what you would expect. I think your answer spot on. I mean, closer to zero. So I think, if one looks globally, the US, which is really pricing in lots and lots of good news, and there's AI and there's lots of things to be excited about, there's probably a lot of over optimism in terms of the prospects for earnings for many of those companies. And yet, if we look at Japan, you've got almost half the index which trades below NAV, and there's plans in place to drive that up. So I think on a risk-adjusted basis, we still see pretty good returns coming out of Japan, and I think it's probably the gap between the exporters and some of the mid and smaller cap businesses now opened up. So we're starting to see deeper value in some of those smaller cap type businesses in Japan. But the bottom line is still lots of value there. And you've got an economy which has still got a positively sloped yield curve. The Japanese government certainly doesn't want deflation to come back. They've just got out of that spiral. So certainly I think they are in a position where they want to continue to see growth in the economy, even albeit relatively slow growth, just 1% to 1.5% GDP growth. I think that all underpins, decent earnings growth from the Japanese market, which would be close to double-digit earnings growth over the next 18 months.
Your last points there brings me to sort of the macro front. And you mentioned, the market's been cheap for a long time, and that was warranted. Japan has struggled with inflation, with sort of low growth. Monetary policy has remained accommodative in Japan in contrast to the rest of the world. What's behind the BOJ's stance, and how do you and the team at Truffle, look at the economic landscape at this point in time?
Mansour, as you've said, the BOJ has had very accommodative monetary policy post-COVID, and I think it has delivered the desired results of generating a underlying economic recovery together with an acceleration of inflation. So the one thing we know is the BOJ and the government does not want to go back to deflation, where they've been for the last couple of years. So I think it's now a question of striking the right balance of monetary policy to ensure the continuation of the underlying growth and inflation, but at the same time starting to release the anchors, particularly on the longer end of their yield curves where you've got those negative rates. So I think what we're thinking and what we think is likely to happen is slowly you'll start to see those longer rates move up, which potentially could be an incentive for many Japanese domestic investors who have lots of capital invested overseas, typically in the US market, in US treasuries, where they've been earning those carries, given the fact that you couldn't earn decent returns in their own market. We can also see that the underlying valuation of the yen is very, very cheap versus the other G7 currencies. And the yen is anywhere between 30 and 40% undervalued vis-a-vis lots of these other currencies. So I think there is a scenario here where we could see capital move back to Japan as monetary policy starts to normalize, given the better underlying economic fundamentals, and that could well see a repatriation of capital back to Japan, which would also then perhaps move the currency from what is quite a weak level right now relative to the dollar to something which is probably more representative of what's happening within the economy. And I think that strengthening of the currency of the yen would be particularly good for the domestic cohort of those Japanese companies. Not so much the many of the big exporters, but lots of the domestic type companies. And as I said up front, many of those companies are still trading pretty cheaply. So your return algorithm is not just the fact that you're getting, almost double-digit earnings growth on a decent multiple with a sort of a balance sheet unlock, but there's also a potential currency benefit for you.
Just to touch on the currency, I suppose from a South African investor perspective, you also get a bit of downside protection, given that the yen acts as a safe haven currency, in the risk-off times.
100%, man. So I think that's another factor for us, which has sort of, resulted in us having an outsized Japanese exposure in the portfolio is when we step back and look at global markets, there's certainly a lot of optimism and frothiness, particularly in the US market, where it's very concentrated. There's lots of capital hiding there, whether it be in their bond as well as their equity markets. And I think in the event of something not transpiring to the extent that perhaps there's consensus that we land inflation immaculately at 2% and maybe that rates don't get cut this year, notwithstanding people still think we got 3 cuts coming, you could see a bit of a shakeout. And I think in that environment is an environment where you quite rightly point out is the yen typically does quite well and strengthens in that environment. So I think, from a portfolio point of view, what we've been doing is reducing some of our exposure to the bigger companies, which are in the Nikkei 225 or in the broader, bigger indices, and gearing it slightly towards more of the small cap positions, which are and mid cap companies, which are more domestically focused and should get a benefit from that strengthening yen. So I think the position almost acting as an anchor in what could become a bit of a choppy sea in the event of some sort of sharp correction or disappointment with respect to US monetary policy later in the year.
Iain, with that, I think you actually just answered my last question, which was going to touch on the Balanced Fund Annex exposure, which I think is quite different from its peers, at least in the local landscape. What are the sort of opportunities that you're looking at in that sort of smaller cap space? Maybe just to give us some sort of insight there.
Yeah, so I mean, when you say in the smaller cap space, are you talking with respect to Japan, or are you talking, in general across the portfolio?
Yeah, in general, in Japan, within the fund.
Okay, so I mean, from a Japanese perspective, I mean, we've got probably 17 or 16% of our offshore equity now in Japanese mid and small caps. We think that that's a decent weighting. We've got a spread across the index. And I think, to the extent that you've got a big cohort of that index trading at discounts to NAV, I think there's a nice value underpin. And I mean, these businesses are still growing earnings. And then I think, generally in the portfolio, what we're just looking for and trying to focus on is margin of safety. Is to make sure that we're not overpaying for assets now in a market where there seems to be more and more appetite to take more risk. Notwithstanding what we think are valuations, particularly in the biggest part of markets, the US, which are probably more on the expensive side, maybe not in complete bubble territory, but are certainly expensive. And I think are not discounting the fact that we may get an interest rate scenario here that is different to consensus and where, cuts are continually kicked down the road. And I think if that is the case, equities in that scenario are vulnerable to lots of this excessive optimism.
I think that speaks very much to that risk-aware approach that you and the team at Truffle very much, try and implement within the portfolio. Iain, we'll leave it there. As always, super interesting. A very, I think, interesting opportunity for investors to take advantage of. But we thank you for your insights. We thank you for your time. Till next time, goodbye.
Thanks, Mansur, and thanks to all our clients who joined us on the call.